So now let's talk about how the tools of economics and the logic of economics apply to your personal life in terms of how you should approach stock markets and personal finance. Or what's the general idea here? So why would you want to invest in stocks? There's two major strategies. One is that you want to beat the market. You want to engage in what's called active trading, in which case you're going to buy and sell stock regularly, and you're going to pick the winners, and you're going to skip the losers, and maybe even you would short sell the losers, thus making money on the losers as well as the winners. That's the standard idea of most of how stocks and bonds and investments are treated in the media and in most of the in movies and films and most of the news. The alternative, another approach, is what's called passive trading. The idea is, well, the market, the stock market particularly, is has yielded the better series of returns statistically over the last couple hundred years, and so what you're trying to do is not pick winners. You're just going to try and replicate the market, and you're going to try and buy and hold. And then when you're in your dotage, or you need the money, or it's time to retire, then you would start to liquidate some of those assets, and you would have captured the returns from the market that typically beat pretty much anything else, whether it's real estate, etc. Although we can talk about more of that why. Turns out that in the long run, passive trading beats active trading. So on average and over time. It is true that you can beat the market in the short run, but any sample of any funds or any specific traders generally over any reasonable period of time, passive trading is going to beat active trading. Now, what we're talking about here can also apply to funds. In other words, instead of buying and selling specific stocks, you can have an active trading fund, and that fund is going to engage in active trading, or you could even own a share in a corporation that is their assets are really just the stocks and other bonds that they may hold in the process of active trading. In effect, with funds, you're paying somebody else to manage your money and hopefully to achieve the goal of the funds. The nice thing about funds is that they can have a lot more shares. So instead of spending however much a stock of Apple costs, instead of buying a stock of Apple, you could take the same amount and have a fraction of a bunch of stocks. So in effect, what you own is a share of shares. Now, what this ends up doing is the nice thing with funds is it allows those of us who do not have millions or billions of dollars to match the market to heavily diversify. Now, if you look at what percentage of mutual funds outperform the Standard & Poor's 500 index in any given year, right? So yes, in 1963, 87% of the funds outperformed the S&P. In 1964, 81%. But in 1965, only 35%. And in 1966, only 8%. And so it turns out that on average, if you look at this, if we look at any sort of sample of funds over any reasonable period of time, the best thing to do is to buy the market and hold. Now, that isn't necessarily true if you believe that you're smarter and faster, as we'll talk about here in a moment, right? Some do beat the market. Some funds, some investors. You may even hear about famous investors like Warren Buffett that has beat the market over a long period of time. So some beat the market. Maybe that could be you. And the claim of most economists here is that most of the people who beat the market, this isn't everybody, but most of the people who beat the market, who do better than the market, get lucky. It's possible that some have skill, but as we're going to talk about in a little bit, we would certainly expect that pretty much anybody who's willing to take your money to manage your money, they're just lucky. So let's see if we can make the best case for luck here. And this really bothers a lot of people because they say, no, but I was smart. I've been smart for a number of years. And, I had a colleague in graduate school who made that claim. He'd beaten the market for 15 years. And he was really smart. And I said, well, okay, so then you had millions of dollars, and you retired, and you started traveling through Asia, etc. And what happened? Well, I got unlucky. I was smart, but then I got unlucky, and I lost my money. And so now I'm back in graduate school because I really, I'm not broke, but I'm not a millionaire anymore. And then but of course, the upside was his intelligence, and the downside was his luck. And this is a tendency for this is a claim that many of us make, right? It's something I certainly have heard in, with a lot of discussions about social justice, etc. Is I didn't get lucky. I earned the good stuff that I've done. I've worked really hard. Truth is, a lot of other people have worked really hard and haven't gotten all that lucky, right? It's similar to, I consider myself to be amazingly lucky. This is a larger, context discussion. But if we look at the historical default, as we talk about in this class, the historical default is poverty, and all of us, basically, anybody born in the last 200 years, by any historical standard, has gotten amazingly lucky. So let's see to the extent that luck could explain what happens. So in effect, let's start here with 1,000 people who are just flipping a coin, right? They're going to buy a bunch of stocks. They're throwing darts. It's random. Basically, we would expect half of them to be right and half of them to be wrong, right? So let's just we're not even picking stocks here. Let's just think about flipping coins. And people have done this, and I've thought about doing this. I don't have a large enough class in my statistics classes in the past, but what you can do is you could have half the class, flip coins 100 times, and then we would take the people who came out ahead, who got more than 50 times they got heads. And we could say, well, you're really good at flipping coins and coming out heads, right? In effect, what we would say is, now let's take those people, let's take the half who chose correctly, right? And the half who chose incorrectly, maybe they conclude, gee, I'm not good at stock picking, I should leave the market. The other half, of course, say, look, I'm really good at stock picking or flipping coins. And so, the next year, there are 500 people remaining in the market. And of those 500 people, what do? They flip a coin again. Half turn out to be wrong. Half turn out to be right. The people who are wrong say, oh, I'm a really bad coin flipper. I should go do something else. The people who got, heads again say, oh, I'm really brilliant. I'm so good at this. I have a gift. And they stay in the market. And of course, the next year we have 250 people, and this keeps going, right? And of course, what happens over time, right? After 5 years here, well, let's see, 1, 2, 3, 4 years, we have 62 people who are convinced that they are genius stock pickers, that they are genius coin flippers, when in fact all that's happened is probability. 62 out of the 1,000 we would expect to be right just by luck, to get lucky. Now, we can of course keep going, and so after 5 years or long, right? So if we keep going, we're down to 3. So after 8 years of people just by luck investing in the market, out of 1,000, 3 of them are going to be convinced that they are exceptional geniuses, right? Out of the other 1,000 who started with them, 997 of them have left the market. It's clear that they're not any good. And so these 3 who are remaining must be geniuses. They have to be exceptional. Well, no. Their skill has nothing to do with this. Now, the tendency for us as human beings, of course, in this instance, is to attribute our success to our genius and our failure to our misfortune. And I think that's just analytically incoherent, and it's certainly incoherent when we look at the data on stocks, right? Now, if we think about this, to be lucky for 30 years, so my friend from graduate school had been lucky for about 15 years and had made all sorts of money, but let's take somebody like Warren Buffett, who was lucky for 30 years. all that would have taken was around 540 million people investing at the very beginning, right? Some of the experts. And that might seem like a lot of people, but again, what we're dealing with in this instance is, do you think people also enter? So we're just running this as though we start with 540 million people. Now this may seem like a lot. It may seem crazy for somebody like Warren Buffett to have just gotten lucky, right? But of course, in 1970, so I'm extrapolating, say this was 2000, that was only 14% of the world's population. Now, that may have been quite a bit, actually, right? Because, not everybody around the world has access to capital markets, not everybody around the world is investing, so maybe that's a little bit high. But of course, if we factor in the fact that new people enter any given year, those new suckers, right? It's not entirely insane. 14% of the world population, I'm not sure that's too crazy. Right? Again, if we compare it to the EU or the US or the Western offshoots share, the group portion of the population who was probably the most plugged into capital markets in 1970, we're getting closer to, that's 80% of the population then. Of course, are 80% of the population investing in 1970 in stock markets, etc.? That's an empirical question, so it's not entirely beyond the pale, right? But that starts to seem a little bit high. So maybe there is room for some people, right? If you get to 30 years and you look at these numbers, you might start to conclude 30 years later, maybe I do have a gift. Maybe I haven't gotten entirely lucky. But you don't want to rule that out. And certainly if you've been lucky for 10 years, certainly in the modern age when the world population is much higher, if you've gotten lucky for 10 years, that's not really all that hard. It doesn't require, that's very easily the result of luck. So again, that's the first thing. And I think that's also a useful life lesson generally, is to think very seriously about the proposition that your fortune has been the result of luck, and your misfortune may also have been the result of just luck. Or alternately, your misfortune may have been the result of your actions, and your fortune may have been the result of luck, right? But it's at least a reasonable hypothesis to ponder in areas outside of just investing, that, right, both alternatives. But certainly with investing, most of the people who have beat the market for any period of time, there's a good chance that they just got lucky. The other reality is it's very hard to beat the market for any period of time. But maybe there are people like Warren Buffett who have some sort of superior vision and they can beat the market, right? So maybe that's true. I'm not ruling that out. The issue is that the longer you go beating the market, the harder this gets. The longer, right, is it ever harder for him to beat the market, even if he has some superior vision that other people don't have. Why is that? Well, the truth of the matter, say he knows which stocks are going to go up and down. How does he take advantage of that information? He's going to have to take advantage of that information by buying or selling. And he's going to have to find somebody else on the side of the deal. So if he wants to buy a stock because he thinks the value is going to go up, he has to find somebody who's willing to sell it to him. And if he thinks the value is going to go down, he has to find somebody to buy the stock from him. Now, as he develops a reputation for beating the market and being very smart, what do you think is going to happen to the availability of buyers and sellers for him when he shows up, right? If you own a stock and Warren Buffett shows up and says, "Hey, I'd like to buy your stock," don't you think you might reconsider? You might say, "Oh, wait. I think you know something that I don't." So the truth is, over time, this knowledge is going to spread, whatever his knowledge is. And so even if he does have a superior vision, it's going to be ever harder for him to take advantage of that knowledge because it disseminates very rapidly. There is a whole industry of people who have sprung up around Warren Buffett to watch and try and figure out and anticipate what he's doing. Now, this doesn't mean, again, he can't still be right. It doesn't mean he can't still profit, but it means that even if he is smarter than everybody else, he's going to have to be really careful, and it becomes ever harder for him to beat the market, right? You always have to have another side to the transaction. And this, again, by the way, is essentially why it is so hard to beat the market. Is you have to be smarter and faster than at least 50% of the population. Or luckier, right? So one of the takeaways here is even if you do think you are smarter and faster than pretty much everybody in the market, over time it's going to be increasingly difficult for you to beat the market. And this really leads us to what's called the efficient markets hypothesis in economics. The idea here would be that the prices of traded assets, such as stocks and bonds, but also cars or real estate or anything else, reflect all publicly available information. So, in effect, if a bunch of people think real estate on the west end of Billings is going to go up in value in the future, they're going to buy it in the present in anticipation of the value going up, and then buying it in the present is going to increase the price of it in the present, which means that the current price almost certainly reflects all available public information. Now, it may not reflect private information. It may not reflect, some specific parcels of land. Maybe there's a recreation facility that's going to go in there that's going to make the available land nearby worth a lot more, and so the price of land may not reflect that information if it's not publicly available, but once it becomes publicly available, we certainly will expect it to reflect that. And this applies to pretty much everything, right? So unless an investor is trading on inside information, or they have some vision and insight that the rest of the population fundamentally do not have. In effect, unless they have information that other people don't have, they can't systematically outperform the market. Now, the main reason you get that information reliably would be to have inside information that is not publicly available. So again, unless you think you have information that other people don't have, now in many cases, as we can talk about in a bit, that sort of information may be, in some environments, illegal, whether it should be or not, or trading on it is oftentimes illegal, whether having it may not be. We could talk about whether laws on insider trading are good for society or bad for society, but really, whether it's legal or illegal, now there's some forms of information that are legal, there's some that are illegal to serve as a basis for trading, but unless you believe that you have that information, you shouldn't expect to outperform the market. Now, as I've already talked about, people, when they get lucky, start to think that they have this information. They start to actually make up stories about what genius information they have traded on and what insights they have that other people don't have. Again, my prior would be that most of the time, I'm probably just lucky. Okay, so this doesn't mean, and this is where we oftentimes go sideways when people take the efficient markets hypothesis out for a test drive. There are proponents, by the way, of the strong efficient markets hypothesis, which I think aren't typically warranted. So some versions, but the clear case is, this doesn't mean that markets are always right. It doesn't mean that the prices are going to never fluctuate. It doesn't mean that people can't be systematically wrong or taken by surprise. It also doesn't mean that traders are necessarily calm or rational. But what it does mean is that you shouldn't expect to beat the market unless you believe that you have inside information or a comparative advantage in analysis. And it has to be a comparative advantage over a lot of other smart people. You can't just think, I'm smarter than 50% of the people. Now again, there's a whole literature on the efficient markets hypothesis, right? I mean, I didn't have this colleague when I was in graduate school, but my father had a colleague in graduate school. They would go to the grocery store, they were on student budgets, and his colleague wouldn't even look at the price of things when he stuck it into his cart. Dad said, you don't care what the price of that is? He said, no, I believe in efficient markets. Well, that's probably a misuse of the idea here, right? There's different products. That product might be more expensive, even though the price reflects all publicly available information. The key here is that you can't, well, you can trade on something everyone knows, but you can't profit in economic terms trading on something that everybody knows. That is fundamentally impossible. Again, unless you get out ahead of it and somehow know this. Now, even if you think you know and you have insight that other people don't have, it's important to remember that there are a lot of smart people in the world. And so not only do you have to be smart, you also have to be fast. And this, if you have followed some of the automated trading stuff, where they are taking advantage of fluctuations, and it becomes ever more important to move the place where they get their information closer and closer to the source of the information so that they can take advantage of milliseconds, thus trading on information that other people don't have, basically by being quicker, or trading on the information that everybody has, but just by being quicker, right? So, one of the things could be, right? Now, I know HBO had a series on Chernobyl. I still haven't watched it. Supposedly it's quite good. But for those of you who remember history at all, Chernobyl happened. It was basically a nuclear meltdown, spreading radiation around Ukraine and Eastern Europe, and given the wind power, probably also, right, some of Western Europe. Now, could be that you were somebody, right, working at Chernobyl or in Ukraine, and you see this and you say, oh, this will probably, Ukraine was a major source and probably still is, if memory serves, a major source of grain, the breadbasket of Russia or the Soviet Union, right? So you might say, oh, you know, Chernobyl's happening. I bet that grain prices are going to increase because this will, in effect, be a decrease in the supply of safe grain to eat. Fair. That's a reasonable conclusion. But in order to profit from that, you have to manage to go trade in grain futures before anybody else hears about Chernobyl, right? Same thing with Fukushima Daiichi, the nuclear plant in Japan, right? So you might be really smart and be able to anticipate what that's going to do to various commodity prices or other prices. But you have to then trade on it before other people can, right? And so again, this is the issue. So even if you know and you're really smart and you say, gee, you know, I'm pretty sure that the price of land in the future, right, Billings is going to continue to grow. I have an aunt who made this claim, right? They're not making more land, which is actually empirically not true. It is entirely possible to make more land, but let's run with that, right? So you say, well, you know, they're not making more land, so we're going to have to, you know, we could make lots of money by buying up land. Question is, do you think anybody else knows this fact? And I think pretty much everybody does. And so, do you think that that is already incorporated into the price of housing or land in Billings? I'm pretty sure it is. And so, in order to profit, you would have to either know something that other people don't about housing or land in Billings, and you'd have to be faster at trading on it. You'd have to be one of the first people to market. Now, there's some interesting examples of this, right? It is true that information takes some time to travel, and that's just a reality. So one of my favorite historical and really beautiful empirical paper was looking at the efficient markets hypothesis. So we're looking at the East India Company, the British East India Company stock price between November and December in 1783. Now, so this stock was traded principally on the London Stock Exchange, but it was also traded on the Amsterdam Bourse, or stock exchange there. Of course, news of major shipments. I don't exactly remember what happened right around 19 November 1783, but probably a shipment of goods did not transpire, didn't happen, or maybe this was a result of some news about the American War of Insurrection or Independence, depending on whether you're British or English, right? But, so this news hit London, and you'll see that stock prices in London and Amsterdam of this same stock traded about the same level. But you see a deviation between 19 November and 26 November. What happened there? Why aren't they moving closely? And the answer is there was a major storm. There was a major storm which kept mail and news from crossing the English Channel, which meant that the news didn't hit Amsterdam until after 26 November. However, as soon as that information hit, then the price of the stock adjusted. Now, if you had access to that news in Amsterdam, somehow you had, right, if you had technology that allowed you to get a telegram when nobody else did. Of course, the telegram wasn't really functioning at this point. If you could do that, then you would have been able to basically short the stock or sell the stock on the Amsterdam Exchange, or borrow money to buy up, yes, the exact mechanics make my brain hurt, but you would have been able to profit from this. But you would have then had to effectively be really quick as well. So there were people who were waiting at the docks as soon as the boat came in, as the mail ships came in, to try and make it to the stock exchange before everybody else. So then they would be trading on news that pretty much everybody had. They would just be quicker at it. And of course, people expend significant resources in doing so, so that even if they do make a positive economic profit in the specific trades, we would expect profit as a whole to go to zero. But it's a nice example of how the transmission and availability of information work, and it's another nice example of the efficient markets hypothesis, right? Because some people could say, look, the Amsterdam Stock Exchange didn't have the right information. The market was wrong on the 26th of November. They thought the price was above 135, when in fact the true value, right, the accurate price was actually down between 120 and 125. But that would be, in my view, a misuse of the efficient markets hypothesis. Because it's not saying that markets are always right, it's saying that prices incorporate all publicly available information, and as soon as that information arrived in Amsterdam, the price adjusted accordingly. So, let's think about some principles for private investing. Generally speaking, you're going to want to diversify. It's sort of the equivalent of the idea that sticking all of your eggs in one basket can be problematic. In other words, you want to spread your risk out. You'd want to buy a lot of different stocks. Again, this is for passive investing. If you want to engage in active investing and you think you're right, you would want to put all of your eggs in one basket. Ideally, you would want to buy all of the stocks in the market, and that, in effect, historically, was close to impossible for most of us. But in this day and age, as we've already talked about, funds do make this easy and possible. ETFs particularly are some that we could talk about. Now, the other thing you want to do is buy and hold. And the reason for that is, A, each trade typically costs something, although as we could talk about in the present day with Robinhood and some other investment services, they now may well not charge you. So that's a recent piece here. The other thing you want to be paying attention to, again, if you're diversified, is not just whether your portfolio is moving up or down, but whether something in your portfolio is moving up or down along with the rest of your portfolio. So, what does this mean? What are the principles of this? Well, this is what's called covariance. For anybody who's has a statistics brain, you can calculate covariance. It's basically the extent to which two things bounce together, move along, right? Negative covariance is going to be moving in opposite directions. Positive will be moving in the same direction. So it goes from -1 to +1. So, turns out you would probably, right, you would want to pick stocks that did not have a high covariance. Because this is the whole point of diversification, is if some of your stocks are moving up and others are moving down, then they can cancel each other out. Whereas if they're all moving up or down together, now that's great if they're constantly moving up, but they're also typically going to move down. Now, covariance is actually relevant for a lot of things besides stock. So, or maybe, right? We can come up with some extensions here. So, should you hold stock in your employer? Right? A lot of employee compensation schemes allow you to buy stock in your employer. Covariance tells us no, because what happens if you lose your job? What happens, or rather, what happens if your company you are working for goes bankrupt? Well, you lose your job and you also lose your pension. They move in the same direction. And yes, while you have your job, if they're doing really well, your pension is going up, but also your wage probably is going up. So you probably, from the point of view of diversification, would not want to buy stock in your employer, again, unless you felt that you knew something that everybody else didn't. Should you invest mainly in Montana if you plan to live in Montana? Should you invest mainly in the United States if you plan to live in the United States? Right? You have an economic upturn, your job is great, you're making more money, your stock portfolio goes up, but then, right, there's a recession, you lose your job, and what happens to your portfolio? It also tanks. So it's also, from the point of view of covariance, it would be foolish to invest mainly in the geographic area where you live. There may be other reasons, right? You might think the returns are highest in Montana or the US. That would be a reason to do so, but covariance would be a reason not to. Should you marry somebody in the same profession? So, right, think about me. I'm looking for, right, so looking for a life partner. Should I marry somebody who is an academic? Well, academia tends to be counter-cyclical. When there's an economic boom, the academia tends to expand, right, contract as students go back and get jobs. When there's an economic contraction, academia tends to do fairly well. So, that's a reason for, right, maybe having a job in academia is a good thing, but the question is, right, do you want to be with somebody whose the business cycle is affecting their industry in the same way, right? So there's an economic boom, universities contract, and you both lose your jobs because the university is doing less well. Well, that doesn't sound like a great idea. So you probably would even want to diversify in the careers of your, right, at least from the point of view of covariance, you might want to diversify in terms of the career of your mate. Now, again, there may be other reasons to go the opposite direction, but covariance and diversification would imply that you probably should choose something else. Another principle here would be to avoid high fees. The point is, as we've already talked about in this semester, small changes in the rate of growth make a very big difference over the long run. So any fees that people are charging you have to be weighed, right, against the long-term implications. Now, right, at 1%, it's going to take your portfolio 70 years to double approximately. At 2%, it's only going to take you 35 years to double. So if your portfolio is getting a 2% return, say you're getting a 3% return. Let's do that. And the fee that somebody is charging you goes from 1% to 2%, your net return is going to go from 2% to 1%, which has a massive difference over the long run. The other thing is, what are you paying them fees for? In effect, you're paying them fees for beating the market, but who's going to be willing to beat the market, right? So people who really can beat the market, are they going to offer to invest for you? Pretty sure they would keep their mouth shut and try and beat the market and just make lots of money. So you can almost, even though it is possible for other people to beat the market, you should almost certainly expect that the people who offer to beat the market on your behalf can't do that. Because if they could beat the market, they'd be off doing it, and they would not be offering to spend their time with your money. So in effect, they're charging you fees for something that they can't do. Now, you can look online, right? Vanguard ETF was one of the first groups to realize the nature of the efficient markets hypothesis. And so what they started doing is they created these things called ETFs, which have low fees, right? So I think initially you can look up the table in the book. Fees can range from 9/10, no, that's 9/100ths. My apologies, 9/100ths% to 2.5%. We almost certainly would expect them to get the same return. So why would you ever pay 2.5%? Seems like a foolish idea. So again, diversify, buy and hold, avoid high fees. The other big one is that compound returns build wealth. And so you may have heard that you should invest early. The truth of the matter is, as we've already seen with growth rates of countries and other things, is that growth in any specific period can fluctuate all over the place. But over the long run, average growth in any given year, average annual growth, can make a huge difference. Now, this is one of the other things, is that the time horizon is going to matter quite a bit. So in other words, are you looking to retire in a year? Then you might want to put things into a different portfolio because of liquidity issues. But over the long run, the market is going to typically be your best investment. Not, of course, over any short run period necessarily. The other principle here is that there's no such thing as a free lunch. Tanstoffel, there ain't no such thing as a free lunch. Which means that if you invest in something for which you get a non-pecuniary or a non-financial benefit, you should expect lower returns. Fundamentally, because you are getting the pecuniary return plus something else. Now, if you were getting the same financial return and you were getting enjoyment of something, what would happen? We would expect people to leave the other thing for which there was no pecuniary return and come over here, which would be an increase in demand for this and a decrease in demand for the other thing, which would cause prices to fluctuate accordingly until the returns should equilibrate. So returning to housing, is housing going to be a good investment? Not over the long run, because you get both the pecuniary, you're eventually able to sell it, and the non-pecuniary return, which is you get to live in it. Does this mean you shouldn't buy a house? No. But it's that you should not expect your house to be a good investment. It should be, right? If your mains, and you also would not want to necessarily, because of covariance, think about this, right? So that's basically, you want to think about strategies for investing. Unless you think you are smarter and faster than millions and billions of people, you should buy and hold. You should diversify. You should not expect a free lunch, right? You should avoid high fees. Now, if you think you are smarter and faster than millions and billions of people, go for it. I think that's fairly unlikely. Now, let's think. So, benefits and costs of stock markets. There's a big discussion about, are stock markets socially valuable? We've already handled that to some extent. But stock markets make large investments possible, as we've already addressed. And markets for financial intermediation make large investments possible. Think about building a very large battery factory for, right, any major car company, as they all tend to go on or electronic now. They would have to set aside retained earnings for a long period of time for most of the companies before they could even think about doing so. So it basically can move the future into the present. They produce a lot of information. You can look at stock prices and see what's happening. Now, again, as we've already alluded to, a lot of the people running these companies do not like stock markets for this very same reason. A decrease in their stock price is, in effect, a verdict by millions and billions of people that their prospects for future are not looking particularly good. They don't like that. They do tend to like the increase in their price, though. Again, it's important to realize that there's two sides to every transaction, and that the current price is the best estimate of a lot of people who are putting their money on the line. The other nice thing about stock markets is they allow the groups of individuals who think that they have a better vision for the future or better ability to act on a vision to gain control of those resources. They also allow us as individuals to spread risk. Historically, if I wanted to save for retirement, maybe I would, invest in local businesses in the town where I live, buy real estate in the town where I live. This would have really concentrated my risk and also laid me open to a significant amount of covariance. Now, there are also costs of stock markets. There are almost certainly always going to be bubbles or fluctuations in stock market crashes. Large groups of people, there may be manias and panics. Vernon Smith, Nobel laureate in economics, has done work demonstrating that the booms and bust cycles are inherent even if everybody in the market knows it's a boom. Because in effect, as long as I think I can get out before it actually crashes, I'm still going to buy in. And so eventually it crashes, and a large portion of the population ends up being wrong. So we have to be aware of this. They might be able to precipitate economic crises, like a stock market crash, as we've seen in 2009 and we've seen some other times. Part of the question, though, would be, why does a stock market crash necessarily precipitate an economic crisis? Because it's sort of like saying, why does a fall in the price of eggs, will that cause a crisis in the egg market? It might, but why? And so people tend to assume that they inherently must spread to the entire market. But there's no good reason I see why that is necessarily the case. Now, sometimes it's true, but it generally requires some subsidiary conditions to be there in order for a stock market crash to yield an economic crisis or a depression.